All right, in today's episode, I'm hanging with my business partners, Drew Niffin and Garrett Lynch, and we're going to jam all about passive investing. We're going to answer the most frequently asked questions from passive investors, kind of rapid fire style. And these are the real questions that we hear every week from people looking to invest with us at Nighthawk Equity. And honestly, obviously, if you're a passive investor, it's going to be a very, very interesting episode. But if you're an active investor or an aspiring general partner, you should know proactively what these questions are and address them in your content and your conversations that you have with investors. This is what's on investors' minds, right? We're going to talk about, well, what is a syndication? What are the benefits? What are some of the risks? So how do you mitigate those risks? How does it all work? And how do I distinguish a good operator from a not so good operator, right? So you should be able to answer all these questions. And if you are a passive investor, then you should know which questions to ask, and also look for what answers to look for as well. So, going to be a cool episode, whether you're a passive investor or if you're an active investor as well. And we'll get into it here. Drew Niffin and my partner Garrett Lynch. Let's get into it. Drew, what are some of the risks of investing in real estate in general, but syndications maybe specifically? What are some of the risks that investors should be aware of?
Yeah, good question. People need to know these things. We've experienced in the last couple of years, right, a market where, as a result of the tremendously low interest rates that happened 3 or 4 or 5 years ago, there's been a lot of apartment buildings built around the country, historic amount, right? And so when you have a lot of supply and the same amount of demand, you're going to see prices be soft. So we've seen prices be soft for the last couple of years. And that's been a big issue for good operators to survive in. And we're pretty proud of what we've done in the last few years to navigate these difficult times. But that's something that can happen, right? So the flip side is that as you flooded the world with money during COVID, there was a lot of inflation. And then the government responds with higher interest rates, and that impacts things too. So these things are some of the headwinds that investors can face. On an operator level, right? If you're the investor and you're trying to choose between this syndicator and that syndicator, this is not a simple business. And sometimes people can get into this business without sufficient knowledge, without sufficient experience, and believe that they can buy a property and it's going to magically go up. And it does take consistent daily work. I know that we grind on our assets every single day and there's messages flying all over. And so smaller operators that have had less experience won't do as well, all things being equal. And so that's another concern that investors need to have when they go into alternative space, is to then choose who's the right operator to manage their capital in the alternative investing world.
All right, so let's talk about kind of the two risks, the market risks and the operational risk you kind of bring up here. Garrett, how do you kind of assess the market right now? So, especially with regards to risk, and obviously the market changed considerably over the last 2.5 years, where clearly the market we're at the height of the market in March of 2022, and that market has changed considerably. So, with regards from a risk profile, how can we help investors make a better decision around where the market is right now, where it might be going?
Yeah, so I think the market right now is in a volatile state. So we went from having basically like the lowest interest rates in history to having some more normalized interest rates, but it's been volatile. It's been up and down. And so anyone that was making a bet on a real estate investment with variable rate loan back in 2021, 2022, those are pretty much not where they said they were going to be at this point. So the good news is that we're kind of on the other side of that. We're in a time now when interest rates have gone up to a high enough level and they've stayed around that level, albeit the market a little bit volatile, that pricing has come down quite a bit. And so we can see a lot more clearly, uh, like post the highest part of the market, we're now kind of like towards the bottom, which is a really good time to buy, but it really is scary for some people because they're like, we don't know what's about to happen. Our investments from a couple of years ago are not worth what they said they were going to be. And so right now in the market, if you're assessing it, you really have to look at, okay, what is the fundamental demand for this asset inside of what's happening in the market? And am I getting a good at a good price point, a good basis from where things used to be? And I think right now the answer is yes. The pricing we've seen come down from 30 to 50% from the top of market pricing. And so if you go buy a piece of real estate and it pencils and it works and you're getting it at the right price, there's a higher likelihood, in my opinion, that that's going to be more valuable in the next coming years than not. And so then you just have to protect your downside on the capital stack and then operate the property efficiently. And so the way to do the capital stack is you just get a fixed rate loan and lower leverage. And so that's something to look out for as a passive investor. Is the operator going fixed rate and are they getting lower leverage? That eliminates a lot of risk. And then the track record of operations. Has this operator done well historically in challenging times? And have they been able to overcome the issues that happen? Or are they brand new and they don't know what they're doing? And there's risk there. So,
Yeah.
yeah.
So market level risk, look at the debt. We're getting fixed rate debt and we're getting comparatively 2.5 years ago, much lower leverage. So all of that reduces the risk. And 2.5 years ago, the outlook for interest rates was up. Everybody agreed that interest rates were historical lows, and obviously the only place for them to go was up. We just didn't know that it would go up so quickly, so much. And now the outlook basically is flat to slightly down, right? The outlook is completely different. And because of the cost of construction, it's basically impossible to build new stuff that's actually affordable. I'm talking about affordable, anything, less than $2,000 a month in rental. So the ongoing demand for affordable rental property is very strong moving forward. So as you said, Gordon, I think we believe that we're kind of towards the bottom of the market cycle, and therefore it is a better time to buy than it certainly was 2.5 years ago. But you had to talk about operational risk. So Drew, I want to ask you about this. So give us some guidance to the passive investor on how to assess the operator, right? What is some of the operational risks that we face, and how can an investor tell whether an operator is better positioned to operate or not? Because in the olden days, any time after really 2015, right? I mean, the operations really wasn't that strong because the market kept going up, and you could be a complete imbecile and make money, and so it really wasn't that important to be able to operate. It just means that you made less money than if you were a good operator. But those times have most definitely have changed. But it's sometimes difficult from an outside investor looking in to tell the difference. So what would be your counsel to an investor who's evaluating different types of syndications and operators?
Yeah, I think it comes down to experience and manpower is what I would say, right? So as you said, in 2015, asset prices were going up so much that operations weren't at a premium, right? So you could just buy an asset. And this is what most people did, truth be told, was they bought an asset, they threw it over the fence at a property manager, a third-party property manager, not themselves. They said, go run the asset, just go do all the stuff. And there wasn't a lot of oversight over that party. And when times were good, it didn't really matter because the rising tide lifted all boats. But now that it's changed, it really matters experience, right? So do you have a lot of properties? Do you have a lot of iterations on looking over the property manager and seeing what they're up to? And the reality is, without going into a lot of details, the incentives of a property manager and the incentives of the owners or the syndicator are usually fairly different. And you need good oversight of the property manager and choosing the right property manager to solve that challenge, right? So then that gets to manpower, right? Which is, do you have people on the syndication team to look over the asset on a day-to-day, literally day-to-day basis to make sure that it is on plan and doing what it's supposed to be doing? Or are you somewhat checked out and you're just kind of on a wing and a prayer, hoping that they're doing a good job? Some operators have that manpower, many don't, and that can make the difference in whether you achieve the goals that you believed as the investor when you invested in that syndication.
Yeah, so what you're saying is you're looking for an operator that actually is investing or investing heavily in the ongoing operations of that. You talked about looking over the property manager. We call that an asset manager on our side, right? They really are looking out for the owners, that is the LPs and the GPs, and making sure the property manager is actually performing and maximizing the potential of the property. But there's also other people in operations as well. Talk about some of the other people, for example, that we have. on staff and why those are important, and maybe investors should look for the existence of those team members as well.
Yeah. So the asset manager we just talked about. On top of that, we have things like a financial controller, right? So we are looking very carefully at the numbers and making sure the ones that you get from the property manager are telling the right story to help us run the asset well and keep it well capitalized. So that's another thing that we have that not all syndicators have. And on top of that, I talk about construction as well. So we have a construction manager in-house that is overseeing the capital expenditures on the property, the improvement of the exterior, the improvement of the amenities, the improvement of the interior of the units that I mentioned before. And that takes oversight. It's a whole other big part of any project where you're spending millions of dollars. And we bring that in-house to oversee that and make sure that someone is really watching over that. That's something that a lot of other groups don't do. That's a big expense. It's a six-figure kind of issue. But we write that check to have a higher assurance that we can deliver on what we have said we believe we can do when we're going out and investing in the deal.
Yeah, construction is one of those things where, typically a lot of places you would think that you hire the property manager to oversee construction. They can to a certain degree, but not when it's a little bigger. Then you might think, well, I'm just going to hire a general contractor. That's their job. The problem is that it's not, doesn't necessarily, just does not work that way. In other words, once again, you need someone in the ownership on the team that looks out for the owner's best interest, kind of like with asset manager and property manager. Same thing with the construction, which is why we've many years ago actually made this hire. Well, we have a construction manager on our team that oversees the general contractor. Otherwise, we have gotten very unpredictable and unreliable results. So what I'm hearing you say is look for an operator that has invested heavily in operations and has some track record over periods of time. Other things to look for, though, Garrett, is when a deal is marketed, and this kind of upsets me a little bit because you see people with a 18% IRR, huge cash on cash return, and the deal looks better than the next deal with a lower return. And a lot of investors they go return shopping, but is that the best approach?
No, it's not the best approach. So each class property has different returns that they spit off. So, and they're different risk profiles as well. So if you're investing in an A class property, for example, you're going to have lower returns because you're paying more for the property compared to how much cash it's bringing in. But that's a place you just park cash. It's low chance that operations go sideways, low chance that that deal doesn't work out as long as it's structured properly. So you're gonna get less on that deal, but it's less risk adverse as well. Then you move down on the other end of the spectrum. D class is really high cash flow, but a lot of risk and not a great investment in my opinion. So somewhere in the middle, B and C class is where you're going to get like modest returns, but you have to make sure you understand the risk profile of each deal, the location, the asset type, what are the downfalls of each type, what are some snags, where can people run into trouble on the operations. Historically, A class is the easiest to run, and then B class is the second easiest, then C class is a little bit tougher, and D class is the hardest. And so that is definitely, I think, in any investment into an apartment complex, the operations is probably the hardest part. And so you have to make sure if there is a C-class building you're going into, for example, you understand the risk profile and you understand the operator has done this before and can take that on and has been successful in that arena. Otherwise, it's not worth it. And so you can't just go return shopping. Go return shopping. That's how you get burned because anyone can throw down whatever they want. They can underwrite it to whatever level they want and throw in whatever numbers they want. You really have to be meticulous about why are they getting these numbers? Is it realistic? And what is my risk?
Well, let's talk about some of the questions that investor, and I think just investors should ask more questions or look for certain information, especially when they get a marketing package, right? They get a marketing package, the returns are just fantastic. What things should the investor look for in that marketing pack, or if they don't see in the marketing package, what questions should they ask? Let's give some examples here of what they should look for or look out for.
Pay attention to the assumptions around the first thing, the reversion cap rate. I think that is a big lever to pull.
What's the reversion cap rate?
Reversion cap rate is what cap rate you're assuming that you're going to get on the exit. And so if you're going in and you're purchasing a cap rate is an instrument really that's used to value a property in a current environment. That's just a general, I'm not going to go too deep into all the cap rate stuff, but right now, for example, you can purchase at a 6 cap. That's market, around 6 cap, and it's based on vintage and it's based on location. And so if you're buying at a 6 cap, it's going to spit off a certain price point that you need to be at to buy that property. So when you exit the property, you're assuming a certain cap rate that it's going to exit at, and that calculation is going to tell you what you're going to pay at the end. And so the cap rate, if you're assuming a lower cap rate at the exit, that means you're going to get more for your property later. If you're assuming a higher cap rate, you're going to get less. And so you have to pay attention to what that is. That's a very important thing to look at, because if things are trading at a 6 cap now and you're assuming a 4 cap in 5 years, it's probably not realistic. And so if some people that do that, that's an aggressive stance to take. Other things that you need to watch out for are their cash flow assumptions. What are they assuming that they're going to get for rents later? So, or after they do their forced depreciation, and then how are they arriving at those rents? That's another big lever to pull. So if they're assuming that, let's say they're getting 1,000 for rents right now, and they're assuming they're going to get 2,000, that's probably an aggressive assumption. Now, if they're saying it's based on whatever the market is getting, of course. So the basic thing is you renovate an apartment, you get more for it, right? So if they're saying 1,000, but they're saying we only need to get 1,150 for rents, and we have all this data to back it, and this is why we think we can get it, that's probably a pretty good assumption, and that may work. And so that's another thing you really got to look out for inside of the operations. What are their assumptions around rental growth?
Yeah.
There's one more that's important, is their assumptions around expenses. So you see people sometimes they come in, there's something called an expense ratio. And so you want to have an expense ratio somewhere, the lowest it should be is 40% of the gross revenue. That's the lowest. It shouldn't go below that tip in a general sense. Conservative is 50%. And then very conservative is like above that. And so if you see someone with underwriting and they're assuming 35% of gross revenue is expenses, it's not realistic, or 30% or whatever. That's a red flag right away, and that will skew your numbers. And so I think those are 3 major levers and 3 major things you need to look at when you're analyzing returns in an investment.
Drew, anything else you can think of?
The last one is the debt, right? So what debt is someone taking? So if there was one property that expected to get a 15% return with 85% debt or leverage, and another property that had the same exact returns with 70% debt, one is much different than the other, right? Because it requires a larger loan and a larger risk profile to get there, right? So I'd look a lot at what kind of debt it is. Is it fixed? What is the duration of the fixed debt? And how much debt is there per dollar purchase price? Those things all have a big influence on the risk. And that's something that buyers or investors should be looking at.
And the compatibility of the debt with the business plan. Like, for example, it's, I have 12-year debt, right? And they expect to refinance after 3 years. Well, did they write in the yield maintenance or the prepayment penalties, right? Did not do that. Well, that's going to make a gigantic difference if you think you can refinance a sell in 5 years and you have 12-year debt. The other thing also that kills me is reserves. Like, how much extra reserves are you going to have at closing? Like, are you going to have a cash buffer, or are you going in it without any kind of buffer at all? Or, for example, are you replenishing reserves out of cash flow? Because if I don't replenish reserves out of cash flow, my NOI is going to be much higher and my returns are much higher. But it's also much riskier, right? So we're always replenishing our reserves out of cash flow as well. So if I remove that out of the P&L, my returns are going to be higher. And that's now why other operators' deals now returns are higher and ours, for example, might be lower. So I think in general, though, the passive investors don't have to be experts in all this stuff, because most investors are, they're successful in their own, whatever they're doing, their job, their businesses. Just ask questions. What is behind the assumptions, right? And do the answers make any kind of sense, right? Because everybody knows they should have reserves and extra kind of money laying around, things like that. So those are what Garrett and Drew kind of talked about are probably the biggest things to look out for. And don't just go return shopping, because it's all about a risk-adjusted return, right? So you had a great return, that's cool. Then what is the risk? Are the assumptions more on the conservative side, or are they more on the aggressive side? And it's cool if they're more on the aggressive side, right? Then now you know where it is in the risk profile. Now you know that a certain particular portion of your portfolio can be more on the aggressive side, and some should be a little bit more on the conservative side as well. So those are some of the things to look for, is to look for that risk-adjusted return. So I think we covered a lot of stuff. There's still a lot of outstanding questions here. But if you're interested in passive investing in real estate, then check out nighthawkequity.com. There's a couple of resources there for you. We actually have a mini course that goes deeper in a lot of these things here. So you can register for free on that mini course. Just go to nighthawkequity.com and just scroll down a little bit, and you'll see the mini course towards the bottom of that page. Check that out. If you are interested in investing in opportunities, then the best way to do it is to just hop on and schedule a call with us, also at nighthawkequity.com. Join our investor club. If you join the investor club, you'll fill out just a very short survey. You'll be on the list, and you'll be the first to know that there's an upcoming opportunity available as well. So check that out if you're more in the passive investing side. So Garrett and Drew, thanks very much for being here today and talking about jamming a little bit about passive investing.
Glad to be here. Thanks for the opportunity.
Thanks.